welcome to another Southbank Investment Bulletin. Well, I thought what's happening in the currency markets it bears some special attention right now because last week we had Christine Lagarde saying that they could sit back at the ECB and look at the results of what their interest rate hiking policy has done. So that pretty much implies that they're done, that they're not going to raise rates any further. They're going to sit back, they're going to wait a while, they're going to see if they've done enough and wait for the long and variable lag to catch up. So that pretty much implies that interest rates in the EU are about as high as they're going to get. But let's just look at what that actually means. So when we think about the size of the interest rate hikes that we've seen uh, so far, what it basically means is that we've seen a lot of interest rates go up all around the world, but they haven't gone up at the same pace everywhere. So when we think about the EU, they're at 4.5%. And then let's just put that into context and think about, well, what are interest rates like in the Federal Reserve in the USA? And they're 5.5%. Now, the other way of thinking about the way that the market thinks about interest rates is to look at the trajectory of government bond yields. Let's do the same thing again. We'll look at the 2-year yield for the EU. And it is currently pulling back from around the 3% level. Now, 3% is a lot smaller than 5%. And that's where we have the US government bond yield. Now, when you think about currencies, there's really only one hard fundamental. There are so many different other things to think about when it comes to currencies, but there's only one thing that is absolutely true, and it's that if you buy a currency, you are selling one, you're buying the other, which also means that you're exchanging the interest rate from one for the other. And if you have owned dollars, you've had an interest rate pickup because if you sold euros and you bought dollars, then you picked up 1%. If you then also had been selling European debt and buying US debt, you picked up 2%. So then the dollar has been very firm. But if the ECB has decided that they're not going to raise rates, well, then the chances of that interest rate differential moving in the EU's favor anytime soon, it doesn't really look likely. So you'd think then that the euro wouldn't be appreciating, but it is. The euro is going up. So the euro is going up despite the fact that the dollar has a higher interest rate. And the euro is going up despite the fact that the bond yields are widely, there's a huge disparity between the two. And the only way that one can rationalize what's going on here with the dollar is that the bond market and the foreign exchange markets, what they're beginning to price in is that the Federal Reserve is also at the peak of its interest rate hiking cycle. And when they do start cutting, they're going to cut much more aggressively than the Europeans will. And that will then rob the dollar of its interest rate advantage and the bond market of the yield advantage. And that's why the euro is now starting to appreciate versus the dollar. But of course, then it's not just the euro. If we were to then think about the broader dollar index, now I like to look at the Bloomberg dollar index because it includes a greater weighting for both the renminbi and the rupee in India. Well, it is breaking lower now. And I think it's rather interesting here that we had this very well-defined range between about 2015 and 2022. It popped on the upside, it failed to sustain the breakout, and then it came down with an even bigger dynamic move to pull back into the range. Well, something that I've seen more times than I can count is that when you get exactly that type of situation where the breakout fails and the size of the failure is bigger than the size of the breakout, then it is quite likely that it will come all the way back down and test the lower side of the range. And conservatively, that means it's going to come back into about the 1150 area. But then we have to also put into perspective that that range was part of a much lengthier advance in the dollar. And the dollar had really been going up for about 8 years. And now it looks like it is likely to come back down. So the debt issues in the USA look like they are going to become more pressing, that the trillion-dollar deficits that have been in play now for the last couple of years look likely that they're going to stretch out for at least the next couple of years, that the full faith of investors in the purchasing power of the US dollar is going to diminish, and that is going to have a serious knock-on effect for the value of the currency versus other fiat currencies. But of course, then you also have to bear in mind that gold prices are very acutely aware of what's happening with the US dollar. And gold is back above the the $2,000 level. It's up to 2012 right now. And there's clearly the potential that as the dollar goes down, gold will go up. Then, of course, the other point that I think has been missing for gold is that the real rate of interest, which has been the clear uh, and longer term bull market phenomenon for the US dollar, it has peaked. It got up to 2.5%. It's come back down to 2.2%, and it's certainly unwinding the overbought condition relative to that 200-day moving average. We've had a sea change in interest rates over the course of the last 3 years, where we had sharply negative real rates all the way through 2019 into the early part of 2022. And then that real rate moved by 3.5%, going from -1 to +2.5. And now it's starting to come back down. So it then implies that the return that one can have from simply holding government bonds is not going to be as attractive in future. So then what that means, of course, is that bond yields are starting to contract, and the return from bonds will be less about the coupon and more about the capital return, which of course also implies that we're not going to be worried about inflation going forward, that it's much more likely that we should be thinking about deflation, because the big move up in interest rates will have an impact on consumer behavior, that the clear potential is that by taking the money out of the system, that it's going to bring out a lot of the deflationary arguments that were very popular in 2019, that this inflation that we've had over the last several years has mostly been because of money printing. And the easy way to stop that kind of inflationary pressure is to stop the money printing. And that, of course, is going to be a very sticky question if we have recessions, because then central banks will be looking to, in fact, increase the amount of money that they have produced. And then that, of course, brings back the specter of inflation. Well, this is really a recipe for very choppy action, for short bull-bear trends, where the money gets taken out of the system to combat inflation, puts back in because they worry about deflation. then gets taken back out again because they get worried about inflation. And of course, this is why people are really worried that what we are looking at is a period more like the 1970s, where we get short, sharp bull and bear market cycles. And I guess with that, I'll leave you for this week and wish all the best to all of you.